Right, hello and welcome to Camel Finance. I'm your boy, Camel, and it's about that time that we did another video on the property or housing market. So this is going to be the third video. I'm going to add it to a playlist. I'm going to build a playlist and stick this one in there. I do one of these approximately every 6 months, and since the channel is relatively new, you probably won't have seen the first two videos. But the conclusion from the first video, which was made about a year ago, was that I don't think there was any imminent concerns of a housing market top, but that likely by the time I produce the second video, we would be able to see some cracks. So then, fast forward 6 months on from video one, which is 6 months back from today approximately, I concluded the following. I think the cracks are visible. I think not only are the cracks visible, but in many areas, these are starting to become absolutely an undeniable reality. The property market is clearly stressed. The aggressiveness, the velocity with which these rate hikes have been undertaken worldwide are clearly putting a lot of stress on the property market and on mortgage owners around the world. To be clear, I'm not calling for an imminent crash in property prices. I'm just pointing at the cracks in the system and saying they look like cracks to me. So there you have it, right? And fast forward today, I guess the big question is, have we continued to see cracks in the system? Have those cracks gotten worse? Right at the beginning of this year, I publicly went short the housing market via Vanguard's real estate ETF VNQ. So this was posted to Twitter. And from a technical perspective, at least, there seems to be some parallels. If I grab this fractal from 2008 and drag it across, we're not doing anything too dissimilar from that so far. Now, could we deviate away from this? Yes. Do we necessarily have to plunge like this yellow fractal suggests? No, not necessarily. But as I'm going to show you through today's video, the cracks that I said we could start to see as of last video are now not only visible, but are clearly doing damage. We can see signs of damage as a result of those cracks. So sticking with this theme of drawing parallels to the 2008 great financial crisis, in blue here, the blue line is the housing market index. Now, you can see during the GFC, we went down, counter-trend bounce before plunging to a new low and a recession set in shortly thereafter. Today, it appears to me that we're doing something very, very similar, albeit a larger, more stretched out move. But you can see again, down, counter-trend bounce, now looking towards new lows, perhaps even with a recession coming sometime in the middle to the late end of this year. All of this is coupled with the unemployment rate from the Bureau of Labour Statistics in orange here, and you can see rolled over during this housing market plunge and counter-trend bounce. And what do we have today? During the plunge and the counter-trend bounce before the resumption to new lows potentially, we also have this rolling over. Now, as it stands at this current moment in time, unemployment is relatively strong, right? The labour market looks okay, at least if you believe the government data. But remember, it looks okay for a while before it then starts to accelerate to the downside. So it hasn't happened yet. But if this is to happen, then of course the parallels to 2008 would indeed be visible. Carrying on with this theme of unemployment rate, again, as it stands right now, okay, not the end of the world. And this could certainly continue to do this for some time. But the setup is certainly there for this thing to start to spike and climb. And that is, of course, synonymous with the things we see during a recession. I am, of course, not calling for an imminent recession, but I am saying the setup is there to see this thing deteriorate quite rapidly. And typically, as you'll notice with all prior instances, things look fine until all of a sudden they're not fine. These tend to be quite sharp, rapid increases in the unemployment rate. These tend to be more spikes rather than steady climbs. So it tells us to keep an open mind about perhaps starting the next leg to the upside for unemployment. And of course, unemployment makes it difficult for people to pay their mortgages. When people can't pay their mortgages, they tend to be forced sellers, and the excess amount of selling on the market tends to oversupply the market and forces prices to the downside. An awful lot of the cracks and the stress that we're seeing on the property market has, of course, been attributed to the restrictive monetary policy that the Fed has brought in. And, of course, that policy has been mirrored elsewhere around the world. As it stands, we are still currently sat at 5.25 to 5.5 basis points, and the cuts don't seem to be anywhere in sight in the near term. So if I click out to May's meeting, you can see there's still a 62% probability at the time of recording that we're going to be remaining paused at 5.25 to 5.5 basis points for interest rates in May's meeting. And it's not until June that we are currently starting to price in the first expected rate cuts. So policy could remain restrictive, interest rates could remain higher for longer, at least until the middle of this year. And again, fitting on with this theme with, can we start to see these cracks show, are these cracks getting worse or better? I would argue they're getting worse, and I'm going to show you why. Because of these restrictive interest rate policies, because we still have higher interest rates, commercial real estate is suffering. Every month, more and more of these properties, particularly in the commercial real estate sector, need to roll over their debt, their current debt. They need to refinance at these higher interest rates. But under the hood, many people post-pandemic now work from home. So this is resulting in a bunch of open offices that are empty. People don't want to roll over and refinance at these higher mortgage rates. They would much rather try to get out of their property, sell the property, and of course then it goes back to oversupplying the market. So commercial real estate has been observably under a lot of stress. Here are some US commercial real estate values over the past year. You can see offices down 25%, apartments down 12%, self-storage properties 11%. So again, these cracks are more than just visible now. Okay, this has gone from being an expectation that we would be able to see stress and cracks in the system to observable stress and cracks in the system. To illustrate my point, this building in Washington, D.C. sold just 2 weeks ago for $25 million. But its last purchase price was $145 million over a decade ago in 2011. So this reflects an 83% loss on a 19-story office building. So you can see this is undeniably stress within the system. This is undeniably a product of having high interest rates and a bunch of people that are now able to work from home, leaving these offices rather empty. People not only have less of a requirement to refinance, but they have far less incentive to pay significantly more money at the higher interest rates. And in many cases, it's likely that they cannot afford to pay the excess for the mortgage rates. Continuing to build on this theme of observable stress in the system, this commercial real estate is even starting to act as a contagion towards the banking sector. We saw shares of a Japanese bank start to collapse as the stock experienced the steepest 2-day drop since it became a public company. Why? Because the bank reported massive exposure to commercial real estate. So again, this is becoming not just an idea that we should see cracks and stress in the system, but an observable reality. This Japanese bank's exposure to commercial real estate has led them to have $870 million in market cap wiped off of their stock in just 2 days. And if I pull up the S&P Regional Banking ETF, KRE, you can see still in a downtrend, continuing to make lower highs and lower lows. In the short term, we have had some relief, but unless we can get a breakout of here and resume to the upside, which by the way is very similar to the setup in the housing market, if I get rid of this fractal, signs of a breakout and a resumption of the uptrend would tell us to breathe a sigh of relief in the short term. Perhaps this could be catalyzed by printing, but until something improves or until we start to see these technical breakouts and resumption of the primary uptrend, it is reasonable to expect rejection at resistance and continuation to the downside. So these banks are in trouble, so are the real estate ETFs. Again, things can change and they can change quickly, but they haven't changed yet. We also have this Evergrande situation still unresolved. And again, just a couple of weeks ago, we saw shares dropping 20% in a single Monday morning session after a Hong Kong court ruled to liquidate the property developer. More signs of stress in the system. Elsewhere in the world, places like Germany are starting to experience massive property declines, and this is in residential properties as well. So this is not an issue that is contained to commercial real estate. Particularly in Germany, we're seeing a huge number of loan defaults. In fact, the greatest number of loan defaults since the great financial crisis. Again, it speaks to the parallels from the GFC. By the way, this GFC fractal comes from this 2008 property meltdown. So again, you can see, not too dissimilar at the hard right edge. We also have an astounding 83% of Americans currently think it's a bad time to buy a house. That is more than triple the 27% low seen in 2020 and well above the 37% historical average. Meanwhile, mortgage demand just hit a fresh 30-year low in January. Current mortgage demand is 54% below the pandemic peak and down 14% year over year. So again, it's observable that these higher interest rates are making home ownership unaffordable to the masses. Even as mortgage rates have started to drop, affordability is still getting worse. As you can see, these are highly elevated levels. And so once again, we have seen deterioration since then. It is hard to make an argument given all of the lower highs in the real estate ETF and all of these lower lows back here, right? It is hard to make the case, unless this was to start breaking out to the upside, that a recovery is coming. In the last video, we thought that 6 months into the future, i.e. today, would look a lot worse than it did 6 months ago. And it's hard for me to say that things look better today. As I've already shown you, commercial real estate is in such trouble that it's starting to bleed into the banking sector. There have been no breakouts visible on the housing ETFs, the real estate ETFs. One argument that goes counter to this is there is an 18.6-year real estate cycle that says we have room to run over the next year or two. But as it stands, I believe this thing has topped early. For things to improve, for house prices to start to move up, it seems that what we're going to need is either a rapid reduction in interest rates, which as I showed you back here, doesn't seem likely for at least a few months, or for them to turn the printers on. But given that the stock market is at all-time highs, they do not have a history of printing in order to liquefy markets at all-time highs. They tend to wait for things to come tumbling down and print at the bottom to prop it back up. we are going to need to see printing or a rapid reduction in interest rates. But as I showed in the last video, a rapid reduction in interest rates doesn't tend to have an immediate effect. What you tend to see is rates start to be cut and then housing falls with it until eventually rates start to normalize, and then housing can usually stage a reversal. The reason being for this is simple. If they start to cut rates now, are you going to rush out and get a mortgage or refinance at 1/4 or 0.5% less than the current rate? Or are you going to sit on your hands, patiently wait for a few months, knowing that usually one cut is followed by many more? So all of these things take time, they tend to lag in the real world, and thus, just because we start to cut perhaps as early as June, doesn't necessarily mean that the housing market will bottom immediately in June. And whether it's a combination of printing and rate cuts or one or the other, unless this all starts to be confirmed by technical breakouts, right? As I said, unless we start to see me be completely wrong on this short and this start to move to the upside and break out above this downsloping red resistance line, unless we start to see KRE, rather than reject a resistance like I suspect it does, break out and move to the upside, we're likely going to continue to see the housing market get worse. And of course, all of this, whilst we're talking about regional banks, against a backdrop of the BTFP, right? The Bank Term Funding Program, which is QE disguised as a loan program designed to plug the holes in the bank's balance sheet that only exist as a result of being forced to buy bonds under the premise that the Fed would not hike rates, only for the Fed to go on the most aggressive rate hiking cycle the world has ever seen, a few weeks after it made that promise not to hike the rates. This BTFP program is a QE in disguise. It is a QE that identifies as a loan program and is currently being used to plug the holes in the bank balance sheets. As I said before, this QE that identifies as a loan program is set to end and expire in March. Once we get there, these banks have a decision to make. Do they lock in and refinance at a higher rate and have to be stuck there for a year? Or do they take a gamble that the Fed is going to be forced to cut in the not too distant future? Of course, if for some reason we're to start to see deposit flight in the banks, that is going to cause the wheels to come off very rapidly, as it will expose unrealized losses that the banks are sitting on as a result of holding the bonds, because deposit flight forces them to sell the bonds and reveal the losses. So in summary, the last video, we expected it to look worse. And like I said, it is hard for me to make the argument that things look better. I would say things look significantly worse. Not only is commercial real estate doing worse, but as I said before, is starting to bleed into the banking sector. Unless we see rapid rate cuts or emergency printing with confirmation of technical breakouts across those ETFs that I showed you, it's hard for me to make the argument that the housing market is going to do better. It seems much more likely that by walking forward 6 months into the future, when I do the next one of these videos, we are going to be looking at significantly lower commercial real estate prices, property prices, and perhaps even a significant increase in the unemployment rate. So I say all of this not to be a doom poster. This is simply me observing the property market as I did in the last couple of videos. I'll be back in 6 months to do another one of these, and we'll see, right? We'll see. Does it improve in the meantime? Is there some kind of printing or emergency rate cut system that manages to buoy this? Or does my base case expectation continue to play out, which is that we will indeed see much lower property prices? I'm your boy Camel. I hope you found value here today. Until next time, take care from me. All the best. Cheers. Bye.